All right, everyone. Well, welcome back. May 2025 markets and economy update. The year's just cruising right along. I feel like we were just talking about year-end stuff recently, and we're at mid-year basically. So before we dive in, for those of you joining us for the first time, we'll reintroduce ourselves. I'm Jarrod Musick. I'm the CEO here at Destiny Capital and on the investment committee with Tim Doyle, who will give you his bio here in a minute. But my role on the investment committee is really to be a thought partner for Tim and thinking at a strategic level about portfolio design and investment decisions, and helping to vet new solutions for our clients. Tim?
Yep. Yeah, my name is Tim Doyle. I'm the Chief Investment Officer here at Destiny Capital. I oversee all things investment management related. That could include things like fund due diligence, investment manager selection, capital market research, portfolio construction, trading, and much more. And it's been a busy month since we've last seen everybody, so there's a lot to really cover here. And I'm looking forward to getting everybody caught up.
We're in a highly regulated industry, so for those of you who have heard the spiel a million times, we apologize, but we are officers of Destiny Capital. We have made every effort to make sure that the information that we're sharing with you is timely and accurate. Please do not make any irreversible decisions based on the content of this conversation. It's purely for educational and discussion purposes. If you already work with our team, please reach out to us. We're happy to talk with you in detail about how to apply any of this at a personal level. If you don't work with us, reach out to us. We'd love to do that. But feel free to reach out to your CFP, your CPA, your tax attorney, somebody who knows your situation and can advise you appropriately. I don't think we're going to discuss any specific securities today, but during this podcast, we do occasionally discuss securities. We may or may not maintain positions in those securities that we discuss. And Destiny Capital is a registered investment advisor. So all the good things that the SEC make sure that we keep track of and do and disclose and all of that. That's why we do all of this. So with that being said, let's dive in. We're going to start today with the big T, right? And it's not trillions, right? When we're talking about budget and budget deficits, it's trillions. We're talking about the big T in terms of tariffs today. So, Tim, do you want to walk us through the wild roller coaster that we've had over the last 6 or 7 weeks with tariffs and trade policy?
A roller coaster it has been, for sure. Yeah, I thought it'd be a good opportunity to get everybody kind of caught up as to where things stand, at least at this point, as we're sitting here recording this. I think we all know, based on what we've experienced over the last few weeks, that things change quickly, and markets can react very quickly to that. And I think that's one of the key points that we want to make about trade and trade policy moving forward. So what's happened lately that markets have reacted positively to? Well, we've had a bit of a de-escalation in the trade war, particularly between the U.S. and China. So when tariffs were announced, China and the U.S. got very, very aggressive. It was almost this economic game of chicken, seeing which country would blink first. And we eventually saw essentially both countries blink at the same time, give or take. And they pumped the brakes on this aggressive posture and just said, hey, what we're doing here is not tenable. So what the U.S. had done was raised tariffs on Chinese imports up to 145%. That's a staggering number. And in turn, China imposed tariffs on U.S. goods imported to their country to 125%. That's since been reduced, thankfully, and we have the U.S. has reduced that 145% down to 30%, and China has reduced that 125% down to 10%. Kind of giving everybody an opportunity to take a bit of a step back, take a deep breath, and then re-engage as it relates to trade. We had some optimism about some conversations between President Trump and President Xi of China. Very little has emerged, at least publicly, about what has gone on there, what any potential solution might be. But nonetheless, that was very welcome by investors because that very quickly was getting out of hand and really worrying the stock market and bond markets to that point. So good to see that de-escalation. We hope that continues. We hope that pattern continues across the globe with other key trading partners, but that remains to be seen, and a lot is still to be decided. We also saw a change in the de minimis rule. This is a rule where tariffs under a certain or tariffs were not applied to certain packages, essentially goods packages under $800, and that was erased when President Trump announced his new tariff policy, new trade policy. That caused a lot of concern. Clearly, there are a lot of packages coming into the United States from China that are below that low dollar threshold, and that was causing some angst in markets, causing some bottlenecks. Those have since been reduced to 54%, so still we still see a tariff there, but not as extreme as it once was. So still waiting for more permanent ruling on that as well, but we saw a change in that de minimis rule as a part of the overall de-escalation. Now, looking at all other countries, we see we've got a 10% universal tariff on all countries except for China, Canada, and Mexico. They get their own special treatment. For everybody else, for now, it's at least 10%.
Our three largest trading partners.
Right.
Yep.
Our three largest trading buddies, they don't get that 10%. In turn, we've got 25% on all Mexican and Canadian imports. So they get the 25%. We get 25% on all automobiles and auto parts, and 10% on, there's a carve out for Canadian energy. So just 10% on that. And what does this look like in aggregate? So the chart to the right helps to illustrate total tariffs over time. And on the far right side of this chart, you see an orange bar, and then you see a blue bar. So the orange bar represented the maximum tariff estimate as of April 8th, 2025. So this was after President Trump had Liberation Day announcement, where he had tariffs on a board for each country that were in some cases 90%, 75%, 72%, huge tariff numbers. And in aggregate, they equated to essentially a 30% tariff on all imports into the United States. That is a huge number, historically huge number. So that if you look at this chart, you go back in history, and you really don't see tariffs rising to that level. Since, with some of the de-escalation, some of the pauses and walkbacks, we see the maximum tariff estimate as of May 19th, at least, is roughly 13%. Let's call it 13%. So still high as it relates to modern economy standards, since globalization has really come into play. But we've seen these levels before, back in 1930s, 1940s, and so forth. So still something very new that markets are adjusting to. But truth be told, while there's been some de-escalation, investors have very little understanding of what long-term U.S. trade policy is really going to look like. Huge source of uncertainty, huge source of consternation for investors, for corporations, and we're really hoping to see some kind of resolution, or at least some answers, some firm answers saying this is what it's going to be. This is going to be permanent. These are not going to be paused, because that just causes a whipsaw activity, and it's really hard for corporations to make decisions about how to deploy capital, how to build, how to grow. So I'll leave it there. We'll get into some of the other ramifications, what this de-escalation has led to on the next slide as it relates to the stock market. But Jarrod, anything else you wanted to add as it relates to all that?
I think there's really two key components to tariffs when you think about it. One is raising revenue for the Treasury, right? It's effectively a new tax, which is paid on the usually U.S. company that is importing something from abroad. So like a liquor importer that imports French wine is going to be the one who pays that tariff. They can choose to pass that on to the consumer if they think they can pass it on. They could choose to try and negotiate a different price with the French winemaker. They could split the difference there, but that money has to come from somewhere. And so we'll talk about inflation in a little bit. So I think that's one element. The second element is you can theoretically think of tariffs as a way to incentivize domestic production. So this administration has talked about really bringing manufacturing jobs back to America, and this is part of a policy tool suite that could be used to incentivize companies to, start manufacturing here domestically. No company is able to retask and remake their supply chain in a 4 to 6 week period. So that part is something that would likely have to play out over the course of years. But just thinking about the two different pieces that come with tariffs, incentivizing domestic manufacturing and raising revenue
Yeah.
for the Treasury. So I think transitioning from there, how did markets feel about all this, Tim?
Well, we've been fortunate. We've seen a big bounce in the stock market across really all major indexes since early April. And a lot of this was driven by the de-escalation that we saw between key trade partners like the US and China. So that de-escalation was really welcomed by investors. It showed the potential for a light at the end of the tunnel that was not catastrophic, and markets were kind of pricing in a catastrophic outcome. And you can see that to the chart to the right, which shows year-to-date returns for the S&P 500, the Dow Jones Industrial Average, the NASDAQ, the Russell 2000, and those are essentially small cap companies, and the US aggregate bond index. So we saw a steep decline starting in late February, heading into March, and as tariffs became more of a reality, and we had a better understanding of what those might look like, and then we had, and you could see in the beginning of April, on April 2nd, we had the Trump announcement of trade policy, and everything just really fell off a cliff there. There was a lot of concern, clearly. But then, since the pause, and since some of that's been stepped back a little bit, and that aggregate tariff rate has been reduced from 30% down to that 13%, at least as of now, markets are breathing a sigh of relief and have a little bit of an optimistic outlook. That's also been fueled by the quarterly earnings reports. So the S&P 500 is almost through with quarterly earnings as of today. The S&P 500 is showing year-over-year earnings growth of 13.6%. That's a really strong number. So stocks are doing their part. If this number holds, it would mark the second straight quarter of double-digit earnings growth in the stock market. So that's great. So markets are reacting positively to that, and some positive surprises as it relates to earnings and companies coming in a bit stronger than expected. But still, some of the reality of the tariffs have yet to set in. And if the longer they're implemented, the more drastic that impact's going to be. But when we're looking at a year-to-date number, we'll just go through these very quickly. The S&P 500, we consider that the broad market, the broad domestic market. So the S&P 500 is up just 1.92%, but still positive. It was negative for quite a long time there over the past few weeks and months. The Dow Jones Industrial Average, that's in positive territory at roughly 1.25. NASDAQ is one of we would call it I guess a riskier index, is representative of mostly, some of the tech companies that you may be familiar with, and tends to be a little bit more growth oriented. That's been a little bit more volatile, still in negative territory, but only slightly. The Russell 2000 index, smaller companies have really been struggling. They've been struggling with high interest rates. They've been struggling with inflation, and then tariffs just to add another straw on the camel's back that's been really tough for smaller companies to endure. So small caps are still down roughly 5%, and it's been tough sledding for small caps for quite some time now. Smaller companies have really suffered essentially since the pandemic. It's been a tough go for them. So they are still down 5%, but did have a strong rebound. So that was really good to see. They participated in some of that upside, where some investors were questioning whether or not that would happen if we saw a bounce. And then the U.S. aggregate bond index, so bonds are up 2%. At least as of this reading. So we saw positive stock market returns. We also saw a historic decline in stock market volatility. So if you're looking at the S&P 500 on your news on your phone or on a news channel, you'll likely note that the day-to-day changes in the S&P 500 are less drastic. So we're seeing less moves of 2.5% up, 3% down, 2.5% up, 3.5% down. Those kind of movements where it's sharp up and down from day to day have become less frequent. And we measure volatility, the S&P 500 volatility, by using the CBOE S&P 500 volatility index. We call that the VIX, and we consider any reading at or above 20 to be volatile, anything at or above 25 to be very volatile. And in April, as of April 7th, the VIX peaked at over 50. That is a very, very high number. That just speaks towards the uncertainty that was felt and the fear that was permeating financial markets at that time. Since then, as of May 20th, the VIX has fallen to 18. So a steep decline as markets have moved higher, and that's been a welcome thing for investors as day-to-day surges in the S&P 500 have lessened, and that's to us that's a very good thing. It shows that calmer waters are out there, and investors are looking at things a little bit more logically. It's less fear-driven. But investors are making a lot of assumptions right now. So I want to be clear about this. Investors are assuming that current tariff rates will not be permanent. They are counting on US leaders and foreign leaders to come to agreements for cooler heads to prevail. And yes, we may see some level of tariffs implemented, but far below the levels that were introduced on April 2nd. So that's one assumption. And we think that, we think markets are assuming that de-escalation will just continue. And that obviously remains to be seen. So we don't have any answers on that as of yet, as to whether or not which tariffs will remain intact. Will they be permanent? Will they be long-term? And with which trade partners will they apply? And those are big questions we don't have answers to. So if we see a re-escalation in trade tensions with China, for example, if they walk away from the table, both sides walk away from the table, and we see a re-implementation of 145% tariff and 125% tariff on US goods, we could see volatility spike back up, and we could see the market decline pretty rapidly. So obviously that's something we really want to keep an eye on, and not get too complacent, and really pay attention to what we own and why we own it, and remain disciplined throughout this type of process, because there still remains a lot of uncertainty, and remaining disciplined really helps navigate periods of uncertainty. So one last thing that came that is actually in recent weeks that hasn't been spoken of much, and hasn't garnered headlines in the way it might have even just a few years ago, is the credit rating agencies. Moody has downgraded its rating of U.S. debt. So it's moved down a tick below AAA, and has moved just a tick down. That's just reflective of what's going on with U.S. debt and uncertainty around that, and the ballooning debt, ballooning deficits, uncertainty around tax policy and whatnot. But markets haven't reacted. Markets have largely shrugged that off, which was really interesting to see. But I wanted to point that out, that's a key component, and that's something that should be talked about by investors, both stock and bond investors. So I wanted to point that out and make everybody aware that that's occurred, even if it's not garnered the headlines that it probably should. Anything else I know that was a lot, Jarrod. Anything else you wanted to touch on before we move on?
No, I think that's great. And it really points back to why the best investment strategy is one that you can implement and stick to for a long time period, right? So we always want to optimize for taxes. We want to be able to rebalance and make sure that your accounts are on target. And we want to make changes as the world dictates that we should make changes. But in general, this is why we do not ever recommend market timing. So we've had clients who have allocated new capital in during this entire time period, and that's where a strategy like dollar cost averaging, where we're buying positions over a 3, 4, 6 week period during this time, so you essentially get the average price, rather than the risk of buying everything on the proverbial wrong day. So I think just volatility is always going to be there. We've talked about this quite a bit, that the average intra-year drawdown in the S&P 500 is about 14%. We saw that. And we saw the comeback all within a 6 week time period. And we could see another one later this year, right? We don't know what the future holds. We don't know what policies are going to be. All we can do is have a solid approach that you can stick to. So I think this is a perfect time period that demonstrates why you do that.
Very good points.
So can we talk about the economy broadly, and really, growth and inflation, which have been key themes and will likely always be key themes, but inflation's been the topic for the last few years. So what kind of happened during the first quarter with those key financial metrics that we watched, Tim?
Yeah, in my latest blog release, I kind of likened the global economy to a Rube Goldberg machine, where you can tip over one domino and you just don't know what the reaction is going to be 5 steps down the line. And a lot of those interactions can't be foreseen on the front end. So I think with the U.S. tipping the domino over as it relates to tariffs, that triggers some other things that impact other elements of the economy in ways that maybe are unintended or difficult to foresee. So some of those include GDP growth, so growth of the U.S. economy, include inflation, and tariffs could impact the labor market. So many of you have likely heard that in Q1, the U.S. economy contracted, meaning that it had negative GDP growth for that quarter. And that was largely expected, to be honest. And the chart to the right helps to show this. The chart to the right shows contributors to real GDP growth on a quarter-over-quarter basis. And it shows, contributors like consumption, business fixed investment, government spending, and another one there is that came into play this quarter. That particular quarter was net exports, so imports minus exports, or exports minus imports. Excuse me.
You had a 50-50 shot, yeah.
And I got it wrong, at least initially. I caught myself, but yeah. And you see to the right, the net exports, the chart to the far right and the bar to the far right, the first quarter of 2025 GDP reading and the contributors there show a considerable net export contribution. So that took away essentially from GDP growth for the quarter. And what happened there? Well, what happened and why? Well, I think most corporations understood that tariffs were coming and prices were likely going to be moving higher. So what they tried to do was stock up inventories, import as much as they could, get ahead of that curve, because they were saying, well, let's get 1 quarter, 2 quarters worth of supply, so we can manage this storm of tariffs without having to impact prices on consumers. We can get things still at current levels, not at higher prices, and we won't in turn have to pass along those higher prices to consumers. So those net exports were a considerable detractor from GDP. And I see that really as a one-off, right? I don't think we're going to see. You look at that purple bar, you don't see it as pronounced in virtually any other quarter on this chart. That was really a one-off and really detracted from GDP growth. So I think moving forward, we're really going to be keeping an eye on the actual numbers. I think net exports will still be a contributor, but not as significant as we're seeing, at least in this quarter. I think according to the Atlanta Fed, they're projecting GDP growth above 2% as it stands today. So, and I think, we watch GDP growth. It's important because 2 consecutive quarters of negative GDP growth are considered essentially loosely defined as a recession. So GDP is a key contributor to whether or not we're in a recession. So that's obviously something we're going to be keeping an eye on. As it relates to inflation, inflation actually hit its lowest level as far as CPI is concerned, Consumer Price Index is concerned, hit its lowest level since February of 2021. It came in a little bit below forecast, and that was a little bit surprising, but not to me. I really hadn't expected the effect of tariffs to be passed along to consumers to levels that might impact aggregate prices just yet. So I think inflation is something we really, really need to keep an eye on, because if tariffs persist and if tariffs are elevated, it's inevitable that those costs, or at least some of that cost, is going to be passed on to consumers, and that's going to lead to higher aggregate prices and an uptick in inflation. And an uptick in inflation is really spooky for consumers. We saw that in 2022, where consumer sentiment declined significantly because inflation had risen to 9%. So obviously, something to keep an eye on there is the inflation trend. And I think we potentially have the ability to see the impact of inflation, impact of tariffs on inflation in the next reading and the one beyond that. So we're still a little bit early to the game to see the impact there, but that's obviously something we're going to be keeping an eye on. And the labor market has remained incredibly resilient. Again, we haven't seen a protracted slowdown in global growth. We haven't seen the high inflation yet. So the labor market hasn't seen as many shocks as it might down the line if some of these concerns persist. But for now, we've got 7.1 million jobs opened in the United States, that's still at or above pre-pandemic levels. So very strong. There are a lot of jobs for citizens out there, and we also have the unemployment rate close to full employment at 4.1%. So the Fed's loose target for the unemployment rate is 4%, and we're just above that at 4.1%, with projections that it could rise to potentially 4.3 later this year. So labor market holding in there, and the labor market will be a key contributor to whether or not a recession is declared. So we would need to see higher unemployment levels for the National Bureau of Economic Research, the official recession scorekeepers, to declare a recession. So if we get 2 consecutive quarters of negative GDP growth and we see weakening in the labor market, then yes, we potentially could see a recession determined. But that remains to be seen. I still see that as, you know, a 50-50 prospect there. Still lots to be determined as it relates to the path ahead. So, Jarrod, anything else you wanted to add as it relates to any of those or anything I didn't mention?
No, I think in summary, the macro, the large economic data looks really good right now. If we take tariff uncertainty out of the equation, we would probably have a very good growth reading as measured by GDP. Inflation would probably still look like where we want it to be, and unemployment might look even a little bit better than where it is today. So I think with all that being said, we're going to segue to the one part that probably doesn't look as good on our next slide. We have our first initial, maybe theoretical, hypothetical look at what the tax bill is going to look like. This is something that we've been expecting based on the sunset of the original Tax Cuts and Jobs Act. A lot of the provisions that were passed in 2017 were scheduled to sunset or end at the end of this year, 2025. There's a lot of arcane budget rules that are tied to why certain provisions in the tax code are not permanent. They have to sunset after a certain period of time. Suffice it to say that we knew something was going to be coming this year, and it's currently going through the US House right now. As we're recording this, it could be done with amendments by the time you're actually watching this. We don't know. But we finally have a picture of what tax policy may look like going forward. Now, there's a lot of caveats here. It has to pass the House, has to pass the Senate, and has to be signed by President Trump. So a lot of ground yet to go, and passing the House is probably the easiest bit. The Senate is certainly going to be a tougher proposition and will likely come with additional amendments that need to be made. So now that we've actually seen it, Tim, how bad is it?
Well, if you think about what tax cuts are intended to do, at least as it relates to investors. So tax cuts would essentially be stimulative to the economy, right? So that would leave more dollars in consumers' pockets to potentially spend. So that's a good thing from a stock market perspective, very, very, very generally speaking. On the other hand, we look at the chart to the right, and we see the potential impact. And this was before, I admit, this chart is prior to the final proposal that is kind of clearing Congress right now. These are some of the estimated numbers and estimated impact of, you know, the Tax Cuts and Jobs Act extensions and so forth. But it shows the revenue impact. And this is what bond investors are really paying close attention to. How much does this impact the ongoing U.S. deficit, and how much will this add to U.S. public debt over time? So will this continue to add to our debt levels over time? If so, that's a significant negative for bond investors. And we could see I don't want to call it a revolt, but if it's clear that we are going to be having tax cuts and a loss of revenue without offsetting income for the federal government, that's clearly going to add to the deficit over time. And that means we're going to be borrowing more and more and more each year, which, if you look at it from the perspective of a bond investor, right now we're already asking bond markets to absorb, let's call it $1.8 trillion worth of U.S. debt each year. It's expected to go up to $2 trillion and above $2 trillion. And if these trends continue, it's going to be more and more that needs to be absorbed by bond markets. And in order to do that, you're going to need to attract buyers. How do you do that with bonds? Well, you raise the rates. So you pay a higher coupon, you raise the interest rate related to that. So we've seen that with the 10-year US Treasury. As it's become clear that there's the potential to add to the US deficit and balloon the US debt even further, we've seen the 10-year US Treasury rise even higher. And that's been a bad thing for existing bonds. So there's an inverse relationship between interest rates and bond prices. So as interest rates rise, bond prices fall. So in the immediate term, that's a bad thing. But the 10-year Treasury is also a baseline rate for virtually many other forms of debt, whether it's a 30-year mortgage, auto loan rates, personal loans, business loans, anything of an intermediate term or longer term would be impacted by a higher 10-year US Treasury. So from a bond market perspective, investors could demand higher and higher rates in order to absorb more and more debt is the bottom line. And that could have negative impacts on the overall economy. As that benchmark rate, that 10-year US Treasury continues to rise, that could cause a lot of concerns because as that rises, so do mortgage costs, and that doesn't really help home affordability for everybody who's struggling with that these days. So, it's on one hand, it's viewed as a positive from a stock market perspective because there is a stimulative effect, but I think we're really going to see and have to pay close attention to, Jarrod, the impact on the 10-year Treasury rate and what impact that could have further down the line on the overall economy. So those are some initial thoughts. I don't know if you have anything to add. I know that was a lot.
No, and I think this is just something we want to raise as the tax policy changes work their way through in the next month or two. We're certainly going to do an update where we will dive a lot deeper on what the final provisions look like and how they all interact and work together. But I think based on what we know, this is not a bill that helps put the US federally on sounder financial footing. And we have, if you think about this as a business side, we have what the US spends. So that would be all of your expenses as a business, right? And we've decided that there's about 70% of that we're not willing to touch because that's Medicare, Medicaid, Social Security, and lots of defense spending in there, right? So you really only have 30% of your business budget that you're willing to even touch. And you're currently overspending. So each year you have to go to the bank and borrow more money and pay more interest to continue spending what you're spending. It's pretty simple that we just cannot continue to do that indefinitely. Something will have to change at some point. So I think, again, we'll wait and see what the final provisions are, but this looks like it will not be helpful for putting the US on a path toward lower deficits, hopefully no deficits, and a manageable debt load over time. So I think that's disappointing, and that's been reflected in the bond market over the last few days as we've seen revisions. I think I looked this morning, and the 10-year Treasuries has moved up to about 4.6. We were down, around 4. I think mid-year last year we were down. What did it bottom out at, Tim?
Oh, below 4,
Below
3,
4.
yeah,
Which doesn't sound like a lot, but considering the amount of debt globally and how much of it is tied to US Treasury rates, that's significant. So I think that's, as we were talking, getting ready for this webinar, Tim and I said, well, this probably doesn't change asset allocation in the next couple of years, but in the next like 5 to 10 years, it will. So this is something that we're going to be very mindful of. Stay tuned. In a future episode, we'll go a lot deeper on it. But not the news that we wanted to see, honestly, from that initial draft of the bill.
Yeah.
Yeah. Well, I think as we wrap up, our slide deck has advanced on its own to tell us we're running out of time here. So thank you very much for joining us. Tim, do you have any parting thoughts or a closing message for the viewers today?
I think as this webinar states, it's pretty clear that there are a lot of unknowns still out there and a lot of uncertainty, and uncertainty can lead to an uptick in volatility. Let's just put it that way. So it's important to remain disciplined. It's important to remain diversified. It's important to remain data-driven in your decision-making and not use gut feeling to drive. portfolio decisions. So those are all tactics we employ here at Destiny Capital. Those are some of our key principles of investing. And as things change and as things evolve, we'll obviously keep you up to date. But for now, it's just remain disciplined and keep your eye on the ball and stay in the game, and we'll get there. We'll get more clarity on all these points, and I think that the future's bright.
Yep. Totally agree. We're still investors for the long term, and
Right.
all of these are manageable things that we want to navigate around. So nothing in crisis mode as of today, and we'll keep watching, and we'll be back with you again soon to give you our perspective. And thank you very much all for all of your time, and we'll be back again soon.
Yeah. Thank you, everybody.
All right. Bye-bye.